So, what's my exact price target for Bitcoin next year? I'm looking at a target range with a strong base around $90,000 and a potential explosive peak near $200,000. Now, I know a lot of people are just throwing big numbers around, but I'm going to show you the specific market signals and macro cycles that make this forecast not just possible, but highly plausible. The signs are clearer than they've ever been. In this video, we'll cut through the noise and break down the why behind the price, from the maturing spot ETFs to new global regulations. We're going to look at the data, not the drama, and build a framework for what's shaping up to be one of the most pivotal years in Bitcoin's history. This isn't about hype, it's about understanding that the fundamental wiring of the market is being rewritten right now, moving it from a speculative retail toy to an institutional grade global store of value. For years on this channel, my game plan has been simple: track how big money, macro forces, market cycles, and new tech adoption all crash into each other. We don't chase headlines, we analyze the underlying systems. My whole approach is built on figuring out where institutional capital is really flowing, how governments are setting the new rules of the game, and what history can tell us about what's likely to happen next. I'm not a Bitcoin maxi or a skeptic. I'm a realist who follows the money. Everything we're about to talk about is based on a synthesis of market data, institutional reports, and a deep read of the capital flows that actually move markets. Let's start with the foundation, the price that establishes a powerful launchpad for Bitcoin in the coming year. I see this base forming around the $90,000 mark. Now, that's not a number I pulled out of thin air. It's a calculated baseline drawn from the biggest structural changes this market has ever gone through. The main force creating this launchpad is the spot Bitcoin ETFs. Don't think of them as just another product. See them as a permanent, massive new highway for capital. Before their approval, getting institutional money into Bitcoin was a clunky, high friction mess. Now, it's as easy as buying a share of any stock. While we've seen some healthy consolidation and outflows in November 2025, the bigger picture remains incredibly strong, with ETFs attracting tens of billions in net inflows since launch. This represents a steady, structural demand that simply didn't exist before. This new river of money has fundamentally changed Bitcoin's market structure. Multiple analyses show the introduction of ETFs has helped to noticeably dampen Bitcoin's daily volatility. Lower volatility makes Bitcoin a much more attractive asset for the risk-averse portfolios of wealth managers, pension funds, and corporate treasuries. It's shifting from a pure gamble into a viable option for long-term strategic allocation. This stability creates a much stronger and more reliable price floor than we've ever seen in past cycles. On-chain data helps paint this picture. The massive ETF inflows have created a powerful psychological and technical support zone. While short-term outflows can still cause dips, a deep sustained crash is much less likely because of the sheer volume of long-term institutional capital that entered at these higher levels. The market is now anchored by serious players who are far less likely to panic sell because of a bad news week. When the price has dipped, the market has shown incredible resilience, quickly reclaiming key levels. This floor isn't just about ETF mechanics, it's also about the maturing market cycle. Historically, the 12 to 18-month window after a Bitcoin halving is when the most explosive price growth happens. The last halving was in April 2024. We are now smack in the middle of that historical bull window. While past performance is never a guarantee, the cyclical rhythm of Bitcoin, driven by its scheduled supply cuts, has been remarkably consistent. Each cycle has built a higher low, a stronger floor, from which the next bull run launches. The fact that the last bear market was less severe than previous ones suggests a maturing asset with growing foundational support. So, to recap the base case, a strong support level around $90,000 is being built by the massive ongoing demand from ETFs, which has in turn reduced volatility and created a strong psychological anchor. This is all happening with the natural tailwind of Bitcoin's post-halving cycle at its back. Now, let's build the case for the ascent. The $90,000 launchpad is just that, a starting point. The explosive peak of this cycle will be lit by a powerful convergence of three distinct yet interconnected forces. I call them the three key signals for a new all-time high. While many are freaking out about recent price dips, they're looking at the ripples. We're going to analyze the tide. Signal 1, ETF maturation and the second wave of capital. The first wave of ETF inflows was huge, fundamentally changing the game, but that was just phase 1. Phase 2, which is just getting started, is where the real wall of money starts to arrive. Phase one was the early adopters of traditional finance, hedge funds, family offices, and savvy retail investors. Phase two will be driven by the slower, more deliberate, and vastly larger pools of capital, major wirehouses, pension funds, and eventually sovereign wealth funds. These institutions manage trillions of dollars and move with extreme caution. They take months, sometimes years, of due diligence, risk modeling, and committee approvals. The ETF approvals in 2024 started their clocks. All through 2025, they've been doing their homework. In 2026, we'll start seeing the results in their portfolio allocations. And look at the data. A huge percentage of Bitcoin's trading volume now happens during US market hours. This is a dead giveaway that the institutional herd has arrived and is now setting the price. The retail driven weekend volatility of old is being replaced by institutionally driven weekday trading. Even though recent outflows have spooked some, these are just the growing pains of a maturing market. The hot money flows in and out, but the steady strategic allocations from major institutions are what will build the next leg up. The fact that institutional holdings, including ETFs and corporations, are now approaching 10% of Bitcoin's total supply is a testament to this irreversible trend. Signal 2, the macroeconomic tailwind. The second driver is maybe the most powerful: the shifting winds of the global economy. For the last couple of years, Bitcoin has been swimming against the current of rising interest rates. That's about to change. Central banks around the world, led by the US Fed, are signaling a pivot. The consensus forecast is for the Fed to begin cutting interest rates through 2026. Morgan Stanley Research and TD Securities both anticipate rate reductions over the next year. When the cost of money goes down, investors look for higher returns, and risk-on assets like Bitcoin tend to benefit disproportionately. It's a simple formula. Lower rates mean more cash flooding the system, and Bitcoin is standing there with a bucket. But it's not just about rates. It's about the slow motion debasement of fiat currencies. Inflation, while cooling, is projected to stay above the Fed's 2% target. This persistent inflation eats away at the value of your savings. Institutions and individuals are waking up to this. Bitcoin, with its hard cap of 21 million coins, is a compelling escape hatch. It's not just a hedge against inflation, it's an insurance policy against long-term monetary foolishness. This idea is gaining traction at the highest levels. We're seeing dozens of publicly traded companies, nearly 100 by some counts, now holding Bitcoin on their balance sheets. More importantly, the conversation around central bank diversification is starting to go mainstream. As the US dollar's dominance faces subtle challenges, the idea of a neutral, non-sovereign reserve asset is moving from the fringes toward the center. Signal 3, regulatory clarity as a global launchpad. The final signal, and the one that ties it all together, is the arrival of global regulatory clarity. For a decade, the biggest roadblock to mass adoption was uncertainty. That roadblock is now being taken down piece by piece all over the world. In the US, the SEC's approval of spot Bitcoin ETFs wasn't just a product launch. It was a landmark decision that gave a compliant framework for institutional ownership. It was an implicit green light for Bitcoin to be integrated into the core financial system. And this isn't just an American story. The European Union's comprehensive markets in crypto assets MiCA regulation came into full effect at the end of 2024. MiCA creates a single harmonized market for crypto across all 27 EU member states, providing a clear and predictable environment for businesses and investors. Meanwhile, major hubs in Asia like Hong Kong and Singapore are rolling out their own welcoming frameworks. We're seeing a global race to become a hub for digital assets, and this competition is overwhelmingly good for Bitcoin. It legitimizes the asset, protects investors, and builds the infrastructure for the next wave of adoption. Regulation is no longer the boogeyman, it's the scaffolding for the future. Before we get to my peak price prediction, if you want to go deeper on all of this, the macro cycles, the market signals, my raw notes, I send out a private newsletter every week where I break this all down in a way I just can't on YouTube. It's totally free. It's where I post my research, my charts, and the big shifts I'm watching before they happen. The link is in the description. I'm also building a full class that teaches the exact system I use for this analysis. Newsletter subscribers will be the first to know when it launches and will get early bird pricing. So if you want that deeper analysis and a spot at the front of the line, make sure you sign up. Okay, let's bring it all together. When you combine these three forces, the second wave of institutional money, a powerful macro tailwind, and the green light of global regulation, you have the perfect rocket fuel for a parabolic move. Any one of these would be bullish. Happening together, they can create a feedback loop that propels Bitcoin to heights that seemed like a fantasy just a few years ago. This is why my peak price prediction for Bitcoin in the next year falls in a range between $150,000 and $200,000. Let's be clear, This isn't just wishful thinking. This forecast is grounded in historical cycle analysis, but it's amplified by the new market realities. History shows that Bitcoin's most aggressive rallies tend to happen 12 to 18 months after a halving. The 2021 cycle peak, for instance, happened about 550 days post halving. A similar timeline would put our current cycle peak squarely in late 2025 or early 2026. However, this cycle has a wild card no previous cycle had: the ETF demand shock. After the 2024 halving, the daily supply of new Bitcoin was slashed to just 450 BTC. In the early months, daily demand from the ETFs often swallowed up 10 times that amount. This creates a massive supply and demand imbalance that historical models can't fully capture. The fixed supply of Bitcoin is colliding with a newly opened, almost infinite fire hose of institutional demand. This is why major financial institutions are releasing their own bullish targets. Standard Chartered has called for $150,000 to $200,000 in 2025. JP Morgan has put out targets in a similar range. These aren't crypto startups. These are pillars of old school finance, and their models are leading them to the same conclusions. The convergence of these factors points toward a potential supply squeeze of epic proportions, leading to a parabolic run that could touch that $200,000 mark. Now, for a critical dose of reality, a move to $200,000 is not guaranteed, and it's my job to be honest about what could blow this whole thesis up. This is not a straight lineup. The biggest risk is a macroeconomic shock. My bull case assumes a softening US dollar and Fed rate cuts. If inflation suddenly gets sticky and forces the Fed to keep rates high or even hike them, that would be a massive headwind for Bitcoin. A deep global recession would also crush institutional appetite for a volatile asset. Regulatory risk, while fading, isn't gone. The trend is our friend, but a sudden hostile turn from a major government, especially the US, could still throw a wrench in the works. A crackdown on custodians, where the vast majority of ETF assets are concentrated, is a low probability but high impact tail risk that can't be ignored. Finally, we have to respect Bitcoin's signature volatility. Even in the most bullish cycles, 30 to 40% corrections are normal. We saw a nearly 29% plunge from the recent peak above $125,000. These drawdowns are how the market shakes out leverage and tests who really has conviction. Anyone who tells you this is a smooth ride to the top is either lying or naive. The path to $200,000 will likely be punctuated by sharp, stomach churning drops that will test everyone's resolve. So, that's my outlook for Bitcoin. A strong base around the $90,000 level seems highly likely, supported by the new structural reality of the spot ETFs. From that launchpad, the powerful trio of a second institutional wave, a friendly macro shift, and global regulatory clarity are the signals pointing toward a cycle peak between $150,000 and $200,000. While there are always risks, the fundamental structure of this market has been changed for the better forever. But that's my take. Now, I want to hear yours. What's your Bitcoin price prediction for the next year? Are you in the bull camp, the bear camp, or do you see something totally different on the horizon? Drop your price target in the comments below. And if you want to stay updated on how these signals are playing out, make sure to subscribe and hit the bell so you don't miss the next analysis.